Hey, how's it going, traders? In this video, I'm talking about what is scaling. Now, how do I average in and out of positions? So I go over my strategy and exactly how I do that. I base it off of fractions and percents, so I use a lot of the whiteboard stuff. If you're watching this on YouTube, there probably won't be any highlights at the end of this. If you're watching this in our course, we will have highlights or trading highlights either in the archives of this or right at the end of this video of me scaling in and out of positions. So again, I've never met a profitable trader who doesn't do this, so it's vitally important that you know how to scale in and out of positions. What is scaling? Okay, so that's a big question. And remember, I told you guys earlier this week, I've never ever made a profitable trader who didn't scale. Okay, so first of all, what is a definition of scaling? Well, a lot of you guys might think it is, scaling your position size, so such as like starting with trading with 1,000, then trading with 2,000, then trading with 10,000, trading with 50,000. That's not what I mean. Okay, that's not what I mean by scaling. I mean, well, yes, that's a type of scaling. What I am talking about is the day to day. It doesn't matter how much you're trading with. You need to be scaling with as big or as little position sizes as you are trading with. So now when I say that, say for instance you're trading with $10,000. That's a lot of you guys in this group have close to $10,000 trading with. So you have $10,000 for a position size. Okay. Now what you need to do is you need to learn to scale in and scale out of that position. Okay. So hypothetically, if we have a stock going up, probably should change color here, and you buy all in 10K and you sell all out 10K, then that's not scaling. I do not know a single profitable trader that does this. A single one. And I have a decent network of profitable traders that I know of that, and to know that not a single one just buys all in at once and sell all out at once. That is a very rookie and beginner move. Okay, because you're too lazy. Not only you're too lazy, but you don't want to be bothered by scaling. It's too much. You want to buy all in at once, sell out at once. And do not say, oh, but Jason, PDT. Okay. So back in the day when I first started trading PDT rules were different. PDT rules, if I bought in twice and bought out twice, that was 2-day trades. If I bought in 3 times, sold out 3 times, that was 3-day trades. In fact, if I bought it, well, it's still like that. It's like this. If I bought in once and sold out 3 times, that was 3 trades. I remember one time I remember the ticker. It was ticker symbol LEE, and you could look it up. I traded this back in college, and this was I made like $600 on it, and all my dorm roommates were watching me. It was the only time I ever woke up before 10 a.m. And what happened was I bought in at once. I had 2-day trades left. Okay, I bought in at once. And I didn't try to take profit or average out. I had a limit order set. Okay, and the stock tapped it and then reversed, filled half of my order, and then I had to cancel it and move it down lower. And just simply by moving it down lower, filled the rest of my order at this price and counted for 2-day trades. And then I was flagged. So I must have only had 1-day trade at that point. So now you are allowed to scale. Back then you couldn't. You had to buy in at once and sell all out at once. Now you have the availability to do so. Now you can't scale in and scale out with PDT, but you can do one. Now, what one do I recommend first before we move on to the non-PDT guys? Now, if you are under, I had to do it like that. Okay. If you're under PDT, in my personal opinion, I think it is more important to scale out than it is to scale in. Now, I think because of this, the reason for this is it's easier to identify where your entry is going to be as opposed to where your exits should be. Meaning, we can get a hold of a stock, say we're trading the break of pre-market high. Okay. We know our best entry is probably buying with anticipation of it breaking or right at that breakout level. Okay. So the entry is, in my opinion, easier. It's easier to identify. Now, say this thing skyrockets, okay? Just absolutely goes parabolic, gets halted going up, resumes higher. Does that happen every time? No, not at all. In fact, most times this doesn't happen. However, if you just said, okay, say this is $3, and our price target is, just say for easy math, $3.50. But it just crushes through $3.50, gets halted going up at $3.60, skyrockets out of that halt up to $4.25, and you really get a hold of the stock. Well, if you only sold out at once, you missed all this profit potential. In fact, I have statistical evidence that I would not be a profitable trader if I didn't do this. Okay, I have broker statements to prove that I did this at one point, and I was not a profitable trader. Because my first year of trading, I actually profited. I actually had a green year. Second year, I didn't. Okay, and it's because I didn't learn how to do this at a younger age. Now, that's why I would recommend scaling in or scaling out as opposed to in. As far as percents go, if you're under PDT, okay, you buy in at 100% of your position size, right? Because you can't buy in twice. So then what I like to do is my first price target, PT1. Okay, I shave off half, so I take 50% profit. So now I'm stuck with 50% of my overall position. Now, PT2 plus 3, this is where it can get interesting. So usually at this point, I would start to look to scale out through 25% intervals. So every price target, I would then take a little bit more and a little bit more. So say my PT3, I have only 25% of my position. If I have 25% left, I would just continually shaving that in half and selling out. The thing about this, though, is if you get a hold of a stock and you still have 50% of your position size and this thing is going parabolic, this is a little bit different. You can do one of two things. If you're above PDT, you can add back in and start to scale back in, which you see me do a lot. But if you can't do that, then sometimes taking 25 and 25 isn't the best. In that scenario, say I have 600 shares left, I would take probably thirds, 200, 200, 200, or take, if I had 500 left, 200, 200, 100. You don't want to just kind of, the goal is to sell out 3 to 4 times. I think more than 4, you're kind of trying to scale too much, and you're not really setting great price targets. Basically, what you're doing is you're just kind of, it's going up a little bit more, I'll sell a little bit more here. Make sure you set price targets. Your first price target should always be, not always, I don't always say always, but majority of the time be take half profit. Because at that point, you should just only be letting profits run out. So hypothetically, if we go back to that example, stock gaps up, just something like this, $3, we know psychological resistance lines and support lines. Our first price target should be, generally speaking, 325 to 335, because it's 10% gain plus 25% interval. So usually at this point, I'm taking half profit and letting the rest right up to 350. Now, if it breaks 350, I'm taking a little bit of profit. Then 360, 375. The point is, I don't think it should be buying at $3, sell out at $3.25, because I honestly do not believe you can be profitable doing that. When it comes to scaling out, like I said, for that other 50%, that just comes with knowledge. If it starts to go parabolic, and you can recognize the parabolic movement, then sell out at a slower rate. If it's a trade that's not really going parabolic but still moving well, generally what I'll do is I'll do 3 sells. I'll do 50% at 1, 25% at 2, and the last 25% at 3. That's just how I normally do it on a standard trade. Let's say it's textbook. Parabolic, it'll be 50, 15, 15, 10, 10, or something like that. Uh, but that just comes with years of knowledge of when this is not going to be a textbook trade. Now, what if you're above PDT? Okay, those of you who are above PDT, it's going to be a little bit different. And I have after this video or after this group lesson, once I have it edited into the course, hopefully I should have after this some highlights of me doing this. Okay. Say we're trying the pre-market high is just one of the easier strategies that a lot of you guys like to trade. Very profitable strategy. Did anything cut out there? Should be good. Okay, it's like it's recording. So in this scenario, what I like to do, and this is transferable to all strategies. Okay, say we're trading break of I've been liking the $3 range. We're trading for the break of $3. Okay, generally, if I have 10K, I understand that every time I add before the break, it's a little bit risky. And as I add, the lower down I add, generally the riskier it gets. So, for example, if this is the 9 EMA, and I try to buy the bounce off the 9 EMA, that's generally a little bit more risky than buying right before the breakout. If I'm buying in wave 1 and I want to hold through the first pullback and into wave 2, that's even more risky. Okay, so to understand that the further down you buy, generally the more risky it is. So if I have 10K, what I would be doing if I were you guys is if I have the intervals here, say this is 250, and then the $3 break, 275, and 295. Okay, so what I like to do is I like to add, you guys know this, with anticipation of the break. Now, if I miss my 250 entry, usually what I do here is I like to add on the riskier entries, like the riskiest I would do would be 25% max of my overall position size. So if I have 10K to trade with, I'm doing 2,500 here. Okay. And then at that point, I'd be doing 2,500, and then I'd be 50% in. And then generally speaking, my last 50% I would deploy right at that breakout level. Now, this is a picture perfect trade. Say I missed 250 and I'm at 275. At that point, it does depend on a few things, what all the other factors are looking like. If this is a really high probability setup, there are times where my starter positions will actually be 50% if it's a high conviction trade and it's not a really risky buy. Say it's at a 290, 295. I'm adding with anticipation in the break, but I want to get a 10-cent a share head start on the stock because of an odds of a fake out, or there's a big buyer, so my confidence increased. 50%, I'm fine with sometimes starting out with adding at 50%. However, if you are above PDT, you probably shouldn't be doing this because you have the availability to infinitely scale in and infinitely scale out. Generally speaking, I never buy in more than 3 times. I think at that point, if you're buying in more than 3 times, then you need to do one of 2 things. Well, 3 things. One, you're going to start increasing risk more than you probably should. Because if I have 10K and I buy in 5K, 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 now I have 15K, and I had 10K set aside, I'm in with more than I bargained for. 2, you're adding too high, and instead of taking profit, you're still adding for a home run trade. You're not being realistic. If your first entry is like 25% lower than your second entry, then you're doing it wrong. You're trying to scale in too far. You need to learn to, there's a point in which you cannot simply continue to scale in, and it's time to start scaling out of your position. Okay, so that is one major thing. So many guys love to be like, okay, 250, 275, 295, 310, buy. And they're scaling in. Jason told me to scale, but the point is, I personally would never scale in more than 3 times. I think you're probably doing too much. Unless you're trading with, say you're trading with more than 100,000, that's different. And that, or you're dip buying, that's a different story. However, you just understand more times you buy, you're kind of just you're going over what you bargained for. And 3, if you're dip buying too much and you keep buying the dip, you have to have enough common sense to understand that you need to manage your risk a little bit more, right? So if you're buying the dip, buying the dip, buying the dip, buying the dip, and then you just start moving your stop loss down, 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 you're buying a dip, that's just making it worse for you, man. You're just digging yourself a deeper hole. So those 3 things, you're bargaining with too much. You need to learn to start to take profits, and you need to learn when it's time to cut your loss and not continually add again. Usually, I add in less than I average out. That is why I recommended if you are below PDT, you can only do one of the 2. I would personally recommend averaging out as opposed to just averaging in, because you have to choose between the 2. I think the reason being, my theology behind this is it's easier to identify your entry. Say I buy off the second 5-minute pullback. It's easier to identify your entry than your exit, because you have no idea how high this is going to go up. You have an idea as to where you should enter, but the exit is kind of the unknown. So you're kind of going into dark there. That's why I like to average out. To recap, if you are below PDT, buy, sell, 100% buy one time. Sell is usually 50, 25, 25 in a textbook stock. If you are over here above P cheap or P, yeah, I guess that. Buy, sell. Generally, I like to do one of 2 things. I like to either buy in with, depending on how risky, 25 to 50%, and then either another 25 to or another 50 to 75%, and then last 25% questionable if I really want to size up. So meaning if I buy on 25%, and I'm still kind of uncertain, I'll add with 50. It won't be all in. That way I have some room to either buy a dip or buy more breakout if it sizes up. If I buy on 50%, I could double it up and be with 100% just as easily. This is usually what I do. Usually my starters are anywhere from 25 to 50%. And then my main buy at the break is $1.50 to 75%. So you'll understand this as you go. I can show you examples of this. The averaging in aspect is a little different every trade, because you have to ask yourself, how risky is this entry, and how much am I willing to risk compared to my overall position size. Okay, especially if you're trying to buy the dip, never go all in with 100%. So on a buy side, I buy in 2 to 3 times max. On a sell side, I sell out minimum 2 to 4 times on the sell side, or more. I guess. Yeah. So 2 to less than or equal to 4, or more than or equal to 4. So that is scaling to a T, scaling in and scaling out of positionings using fractions. I like to use easy numbers. These are the numbers that have led to my success. I have not been around for 100 years, so I can't tell you doing a 30, 30, 30, 30, or a 25, 22, 28, 30, whatever you want to do for scaling in and out. Personally, I like to do 25, 50, 100%, things like that. That's how I average in. That's how I average out. If you are under PDT, you still can average out. Do not tell me you can't. This rule was way harder back when I traded below PDT. Just to let you know, it's changed over the years. Back then, I couldn't scale out. I literally couldn't. Now you can. You have it easier. Is breaking the previous day's high a day a good indicator of positive movement? Volume isn't there though. If the volume isn't there, that's a good short opportunity. We've done that a lot. I don't have really many live examples I want to show you right now, just because I do this every single day in the live stream. But is there any questions when it comes to scaling? How to scale? Why I scale? What's the reason for it? Anything? Any questions about scaling? Also, I want to review your guys' trades. If you guys take a trade, either record you trading it live, which will be easier, or screenshot it and send it to me. No, oh, good question. Good question, Carvix. I did not answer that. Good question. Thank you for asking that question. Okay, so Carvix asked, what happens if you're averaging in and the stock reverses? Say I'm trying to average in here for the break, right? I'm gonna size up for the break. No, the answer is if the stock starts to reverse and is not going the direction you wanted, you must always sell out at once. You should never average out when stopping out. So no average out. So never average out when stopping out. Okay. That is just, in my opinion, silly. If you're stopping out, you're understanding that the probability is no longer in your favor. So it's in your odds to just have no shares as opposed to some shares. Okay. In my opinion, stopping out, averaging out when stopping out is not a good idea